Today is a big, big day. We're finally going to be hopping into the charts, and I'm going to show you exactly what you are looking at and what it actually means. So, in this lesson, we are going to be going over exactly what candlesticks are, what they represent on a chart, how it forms, and how to actually interpret it like an actual day trader. So most beginners just look at candles and guess which way price will go. They think that some of the candles don't really matter, but in context, each and every candle does matter. And by the end of this video, you'll be able to read what is going on in your charts, why the candles are moving, and what it actually means. So, going right into it, a candle is a visual representation of where price has moved over time. So, there are four main components of a candle. So, you are going to have your body, which, as you can see right here, I drew out some candles. Your body is going to be this big green wick or big green body right here. And then the second component of a candle is going to be the wick. And looks like a candle wick. It's just going to be a little wick right here. You're usually, most of the time, you're going to have one on the top and one on the bottom and only one body. So two wicks and one body. Now, what does this actually represent? The bottom of a candle, for example, right here, this is going to be a bullish candle. We should probably go over the difference between bullish and bearish. Bullish is when the market is going up. So if the market is bullish, that means the market is going higher. If the market is bearish, the market will be going in a down slope. Putting this in context of actual candlesticks, a bullish candle will have an open down here and close higher, making it green on a normal chart. A bearish candle will open at the high up here and close down here at the bottom of the body, making it a bearish candle. So, putting it in context, what actually these wicks mean and what a body means. For a bullish candle, what this means is price opened right here where it says open. So if we look over where price opened at around 24,300. And this represents the chart. Price chopped around a little bit, went down, creating a wick, went up to the high, and then closed at the end of the time period back at the body. So what the body represents is the candle open and the candle close of that specific time period. So let's say that this is a 15-minute candle. Right here. So this is a 15-minute candle. We'll make it black and reduce the font. So 15-minute candle. This means, let's say it's 9 o'clock. From this candle represents from 9 to 9:15. So at 9, price started here. Let's say 9:03, right? Price chopped around, came down, creating a wick, and then between, let's say, 9:03 and 9:12, the candle came all the way up here, and then at 9:15 the candle closed back here, which represents it opening at the body and closing at the body. Wicks represent where price went. So price went up here, but closed back down here. That is going to be for a bullish candle. And for a bearish candle, it's basically the same exact thing, same exact logic, just opposite way. Same thing. If we use the same concept of this being a 15-minute candle, right? This is the body, the red is the body, and these two little candle-like wicks are the wicks. So, price opened up here because it's a bearish candle. So on a bearish candle, it's always going to open at the top and then close at the bottom. So, you're going to open here at 9 o'clock. From 9 to 9:05, price goes up, creating a wick. From 9:05 to 9:10, price comes all the way down here. And then at 9:15, price goes back up and closes and ends the 15-minute candle, creating this long body with an open and a close. And these two wicks represent the outside drawing, basically. Price went up here, didn't stay up there, but went down. So that is going to be your neutral candles. Over here, we have two different types of candles that you could there's thousands of different types of candles. These are going to be your main bullish, main bearish, and your neutral candles. Pretty much when you see a candle like this candle is called a doji, or you can memorize it as a hammer because it kind of looks like a hammer. For a bullish candle, let me get my little drawing tool right here. So, if we're going based off a doji candle right here, this is extremely bullish price action, because if you look at what we just went over, what it is telling me is price opened right here. Say it's a 15-minute candle again. 9 o'clock. Price opened right here, right? We chopped around. Price decided that it wanted to drop all the way here. And then by the end of the 15-minute cycle, price came back up and closed right here. Meaning, open here, price came down, came back up, and closed right here. So this means that when it came down in this price action, it wanted to stay bullish. It wanted to go up. So this is showing extreme bullish action. Same with this because it's pretty much just straight up. This is going to be two examples of bullish candles. Bearish candles are going to be the same thing. This is going to be another doji or hammer, whatever you want to call it, also representing bearish candlesticks. Now, when you see that there's a very, very small body, so if you think back to what I said the body was, where it's going to be the actual middle of the candle that's colored, and the two wicks on each side are equal, that is a neutral candlestick, meaning it is nor saying it's going to be bullish, or it's also not saying it's going to be bearish. It's very neutral. So if we go and look at this in real, like actual candles, we can see different types. So going deeper into candlesticks, these candles form because this is when buyers and sellers interact at every single price point in between the range. And the body shows dominance, and the wicks show rejection pretty much. So if we zoom in right here, if we go back to the hammer that I was talking about, you can see the wick showed rejection, body showed strength to the upside, and then we continued going up. So an analogy that you can use for candlesticks is going to be like, imagine kind of a tug of war. The body of the candle shows the team that actually moved the rope, and the wicks, that's the other team trying and failing. That's a good way to think about it. So a long bullish body is going to be strong buying pressure. Long bearish body, if we go back to what we were just on, So, long bullish body, strong buying pressure means market wants higher prices. A long bearish body to the downside means strong selling pressure. Market wants to move lower. The doji or the hammer that I was talking about, it's going to be these two right here. Small body, long wick shows indecision and balance. And basically, whenever you see just shadows like this, where the wicks are going to be shadowing, this is going to be rejection of certain price levels. So the key to looking at candlesticks is never look at a single candle in isolation. Always put it in context. We'll go over trends in a different video, but you always want to stick to it in context, and you don't want to just push your bias on just one candle that you see. So one tip that I can kind of give is most beginners often trade based off one candle's shape, and they don't really wait for structure and context. There's going to be a lot of things that come into play when you're actually looking at a chart. And if we go in here and we're going to start looking at actual live price action in candles, there's a lot of different examples. So I'll show you guys some strong bearish candles. Let me get my little tool. So right here, we can see that this is a super strong bearish candle. Black basically represents bearish price action for my chart, and white represents bullish price action. So what this candle right here represents is it opened here, right? Came up, wicked here, came all the way down here, and then just like that, that's basically what the price action inside of this candle is. Let me see if I can zoom in on this price action right here on the 1 minute. What is going on here? Okay, so if we replay back to this candle, we'll let this candle play and go to the 1 minute. So that was a 15-minute candle. What we can see happened was, let's find the candle open. So price opened right here at 10:30. So this 15-minute candle is going to be from 10:30 to 10:45. Price opened here. This will be actually very helpful. High time frame power of 3. And then move it to the 15-minute. There we go. Okay, so as we can see, price opened up here at 10:30, came up, creating this wick, then price moved lower for bearish price action, and closed back up here. This is an example of a bearish candle. We'll go back to the 15-minute, and the opposite is going to be a bullish candle, strong bullish. It's going to be the same thing as a bearish, just except the open is going to be on the lower, and the close is going to be on the higher. Now, we can see a doji in consolidation, basically meaning this is why you don't want to trade just based off candles, because if it's in consolidation, then it's not going to mean much. Let's find one right here. So I'll circle it for you. Right here. That candle right there is a doji candle. If you remember from before, I was saying doji candles show strong decisiveness in a direction or one other. See this doji, the hammer is at the bottom, which usually would indicate that the price is going lower. The reason that it's not indicating price is going lower on this chart right now is because you need to use it in context. What I mean by using it in context is if you zoom out to the higher time frame or the bigger picture, you can see there's no real trend. Market's just kind of staying within this little bubble right here. So you don't want to trade candles based off just a singular candle because you need to get the whole bigger picture. So pretty much recap is a candle equals a snapshot of what happened in time. It's kind of like a picture pretty much. It shows you what happened before and what's happening on the lower time frame of the actual candle. So candles only matter at key locations. High, low of the day, range highs or lows, premiums, discounts, sessions highs and lows. We'll go back into what that means in a different video. The most important thing is you need to understand what different candles mean. So I've been saying that these are 15-minute candles because as you can see right here, we are on the 15-minute chart. These candles change based off of what time frame chart you're on. So since we are on a 15-minute chart, that means each one of these candles represent a 15-minute time period. So if you think about that in context, there are 15 1-minute candles inside of this candle. Same thing if you go to a daily chart, which you just click daily up here. Each one of these candles represents one whole day of price action. So as you can imagine, these daily candles, when you were taking them into context, are a lot more important than the 1-minute candles that you were taking into context. So basically, context is king. Never trade a candle alone. Look for structure, liquidity, and candle behavior together. So in the next lesson, we'll be building on this by learning about trends, how these candle work together and form higher highs and higher lows, and how you can spot a bias before most traders even see it.